Good afternoon, ladies and gentlemen, and welcome back. Cyber Trading University presents our Closing Bell webinar series. Now, for those of you that do not know me, my name is Josh Levitin, one of our senior instructors here with CTU. Let me get a quick sound check so I know everybody can hear us loud and clear. All right, perfect. Richard, Ted, Jose, John himself, our presenter today, gracing us with his presence. Posey. All right, perfect. All right, guys. Well, I had mentioned in our trading room, and of course, a student like Leda knows as well, that I had mentioned in our trading room that we had a special guest with us today, a great friend of ours here. So today we have John Seville from Acorn Wealth. So, what John will be presenting with you guys here today is exactly his title, Market Meltdown, his favorite trading strategy to trade the current environment. So, what John will be going over is essentially $1 trillion short on the S&P 500. You heard me right. John's going to go over exactly his fundamentals, including his special technical analysis techniques he uses to provide that coverage. Aside from that, he'll be going over his strategy that predicts the major market shift 2 to 3 weeks before they happen. So predicting the moves before they happen, especially going into an extremely volatile autumn season that we have right after the Labor Day holiday here with us here in the States. And aside from that, you're going to learn to piggyback the smart money move, much like we do here at CTU, following the smart money. And finally, possibly the most possible, most powerful, and profitable crash setup of our time. So, to give a quick introduction as far as who John is, John has spent the last 11 years mastering the art of technical analysis as a method defining trading opportunities on North American equity markets, much like we do here at CTU. But John is a master of tech analysis, so he'll be going over exactly his favorite techniques, as I'd mentioned. Him and his team at Acorn Wealth have been able to identify entry and exit points on the market prior to the collapse in 2008, 2010, and then most recently in 2011. So, nevertheless, let me introduce the man himself, John Seville. John, are you there?
Oh, I certainly am.
There we go, John. The floor is all yours.
Thank you so much, Josh, and thank you very much for that kind introduction and for having us here today. We This is one of my favorite topics, and we really should update the introduction because or some of the key points there, because really this from 2011, this has continued to cycle through. In fact, to the recent points we exited the market actually in July of last year and December of last year, and we've been on the precipice of waiting for the next big trigger. So there's been a couple of other key breakdowns, which again is used has been signaled with the same types of setups that we're going to talk about today. So thank you for sharing your time with us this afternoon, and I hope you'll find some real great value about what we're going to discuss. We will be talking, of course, about live markets, so we'll just get the disclaimer out of the way. This is for educational purposes only, not a recommendation to buy or sell the securities we discuss. And obviously, we'll hopefully get a bit of time towards the end to talk about a lot of the positions that you may be interested in overlaying our technical field too. But obviously, I mean, you're all part of a great group of educators here already, but just for the fact that you're in this room. So I won't bore you with too many of the fundamentals, but I think that in markets like this, where we have a lot of concern and excitement pushing the market in both directions, one of the key problems why people don't make money, whether it's a new investor who's just struggling to come to terms with the market, or a seasoned investor who is trying to take action in an uncertain market. Often we all miss good opportunities because we fail to take action. And just before we keep going, is everyone can everyone hear me loud and clear, or do you need the mic louder or softer? Very loud. I can a bit softer. Okay, I've turned it down just a touch. Hopefully that is a little bit easier for everyone. I tend to speak quite loudly anyway. All right. Yeah, so most people don't take action. And the reason why most people don't take action, and this is something that we surveyed all of our students all of our students from over the course of the last 6 years that have kind of come online with us, we asked them what were the biggest things that they struggled with, and they said the problems that they struggled with was knowing when to get in and take profits. Excuse me, when to get out and take profits, I should say, selling too early before a stock takes off, knowing when to limit losses and avoid holding on way too long, and having the confidence to execute. A lot of the time that we have these problems is because we fail to execute on the rules or have a lack of confidence in those rules. The main thing that Acorn therefore focuses on, and what we're going to lead into today, is really putting together systematic approaches for how we can make decisions. And that really, and I'm sure that you obviously, when you look in, when you start your day for looking for a trade, you have a methodology of what to go about looking for. You know, the big movers in volume, the pre-market movers, things like that. You know, of how we locate possible opportunities. And where we really fit into the mix here is where we start to say, okay, well, when we get a trade idea that we're looking for maybe a 2-hour move or a 3-week move or a 3-month move, you know, we need to have some kind of quantifiable way to take that idea and put it through a process where we can check it off and say, yes, this is a great idea, or no, it's a terrible one. Does that make sense to everybody? Exactly. Sorry, I lost the microphone there. Yeah, so and now, and even more importantly, once we start developing a checklist of defining, okay, what is the perfect scenario, go one step further and say, well, if we know exactly what the perfect scenario is, if we know what the best possible trading idea would look like, then why don't we use technology in order to find that? And that's kind of where the majority of my work in the last 10 years has been spent, has been really defining what is the best possible recipe, and how can we replicate that 1,000 times, and how can we develop therefore a scan of how to find that. So one of my favorite quotes here, take calculated risks that is quite different from being rash. So what we ultimately want to be able to do is create a system that we can follow that allows us to make the same decision 1,000 times. And when we get into that decision, we're not doing what a lot of people do, which is they get an idea and they go and they analyze it with these indicators they've learned from here. They go and double check it with the indicators they've learned from there. And hey, shock, the indicators don't agree with each other. One system says buy, the other one says sell. Well, now what do you do? Okay, well, now we go to stock twits. Now we go onto the stock forums. Now we go into, what Jim Cramer's saying. And by the end of this whole process, we've gone through enough analysis paralysis that we're even more confused than when we started out. Doesn't work at all. Does anyone ever feel that they get into that? I still get into that sometimes. So it doesn't mean that pro traders don't still go through that loop occasionally. But what we want to replace that process with is an ability to not worry about whether we're right or wrong, not constantly trying to get every trade into a profitable trade. That's not the objective for me anyway as a trader. My objective is to not worry about whether I'm right or wrong, but to be concerned with whether I'm following the rules or not. And that, to me, is the definition of a good trade. Not whether it's profitable or a loss, but whether it's rule-driven, because rules are ultimately what makes profit last long-term. And so when most people talk about their decision-making processes, about all the different things, news, friends, things you're familiar with, these are all kind of great inputs, but how do we systematically approach whether it's a good trade or not, and trying to avoid all of the emotional drawdowns that lead to losing money? And that's ultimately what makes people lose. It's not anything else. It's not that you're bad decision makers. It's simply that the market is designed to make people make bad decisions, and that's why people lose money. They're drawn into emotion because they have a lack of structure, and that lack of strategy causes a directionless trading. So let's talk about getting into how we create a structure. You know, what should our rules be? And so this is one question I'd like to throw out to everybody when we're starting out this topic is if we were to sit down together and I said to you, right, you tell me exactly what the absolute perfect long would be. I want you to draw the chart, and I would like you to also write down the conditions of what the absolute home run, godsend, perfect long would be. What would you write? What would that look like to you? If anyone wants to throw some ideas in the chat box, does anyone know exactly what that looks like? I'm sorry, could everyone see my screen? I may have, someone just pointed out that the screen wasn't changing. Ah, well, there you go. Sorry, yes, I have been changing screens. I haven't used this program for a while, so I didn't have the screen sharing on there. Okay, all right, we didn't miss any of the good stuff. That's important. All right, thanks there, guys. Okay, so if everyone would sit there and draw exactly what the perfect chart would look like, what would it be? So let me give you an example. Let's say we were going to look for the perfect short. What would that look like? Well, let's get creative. Let's say, okay, well, let's start with a chart. What is there? Now, if we talk technically, we'll start technically first. What is the weakest? Does anyone know what the weakest, most bearish chart pattern is in a bull market? Even in a bear market as well, obviously, but we're in a bull market right now. So what is the most powerful bearish pattern in a bull market? To short. What's the most powerful bearish pattern in a bull market? Leader says a bear flag, bearish engulfing pattern, and there we go. That's what I was looking for, head and shoulders. There are over 100 different technical patterns in the stock market. And so the first thing we want to do when we're understanding, looking for the perfect trade technically, is we want to understand the power of a pattern. Now let me just delete this. Can everyone see the whiteboard there? Okay, great. All right. So when we start to talk about powerful patterns, just to give you an example that you might say, John, 100 patterns, really? That's a lot. Where do these 100 come from? Well, we've all heard of double tops, right? But did you know that we can get Eve and Eve double tops? We can get Eve and Adam double tops. We can get Adam and Eve double tops. We can get Adam and Adam double tops. There are 4 different types of double tops alone. And following the ranking or rating system that we subscribe to, an even Eve double top ranks 39 out of 100. The Adam and Adam double top for a short position, looking for a short trade, ranks 13 out of 100, based with no other confirming factors, no indicators, just purely the pattern alone. An Adam and Adam double top ranks significantly higher than an Eve and Eve. How many people didn't know the differences between those, that there were these different permutations or different types of double tops? So this is just one thing. I mean, imagine being a poker player and not knowing the difference between a royal flush or a straight, and not knowing which one would win. You couldn't be a professional poker player and not know that. So how can we be try and become a professional trader without knowing the probabilities of the hands, meaning the patterns that we're trading in our portfolio? So to answer the question before, what is the most powerful bearish pattern in a bull market? It's a head and shoulders. This ranks 1 out of 100 in bearish patterns in a bull market. There's also three types of this. You can have a rising neckline, you can have a flat neckline, or you can have a declining neckline. Does anyone want to guess what the most powerful of this powerful pattern is? Ascending, flat, or declining? Declining, exactly. So that all three work, but those three would be the best. So now we've determined what the most effective pattern would be. Well, now we can go one step further and say, okay, well, once we have that pattern, once we have that head and shoulders, I'm just going to draw a simple one here. What makes a head and shoulders even more powerful than that? Well, firstly, what we want to see is as the head and shoulders is created, we want to see more volume. We want to see more volume on the left side than, don't know what's going on here, one second. All right. Yeah, I won't bother drawing it again. You can see. So basically, we want to see declining volume, less and less and less as the head and shoulders builds. So as the stock makes higher highs, we want to see that the volume is declining. Okay, so that's another checkpoint. In fact, we can summarize that by saying we want money flow or smart money to be going out of the stock as the stock increases. So now we've started to talk about price action. We've started to include volume. We've included the pattern. Let's go even further than that. Let's start to include indicators. We could say that we want to have a break underneath the 200-day moving average and the 20-day moving average as the head and shoulder breaks. We could start to look for directional movement indicators to cross, showing a momentum drop. We could start to say, we could start to throw in fundamentals, and we could say, okay, while this bearish pattern is created, we also want there to be a price to earnings ratio of over 300. We want there to be really high P to E ratios. We could also add to that, and we could say on top of that, we want the insiders to be selling. In fact, we want there to be more selling coming from the insiders in the last 2 months than in the entire 2 years previous combined. Let's throw that on the board. What else? Okay, the institutions that own the company. We want them to be selling as well. And what else? Okay, we want the insiders who've been selling this company to have a track record of every time they've sold in the last 5 years, we want to see that the stock dropped 30% after they sold. Oh, and one more thing. We want it to be in the sector that has had the most amount of selling in the last 90 days than any other place in the stock market. Now let me just throw that at you. Does that sound like a pretty much perfect recipe for a short? If we could have all of those things happening right now. I'd agree with you. And this is why I've spent the majority of my work and my lifetime as a trader finding those setups. So let's push forward. But these are now we might not always find this idea, but we really need to be thinking of we have to be thinking about what that recipe is. We have to have a goal of what we want to trade, because if we don't know where we're going, then any road will take us there. And if we know what the perfect trade would look like, why not use technology to find it? So the first step is obviously understanding some of the core values that moves the market. I think all of us would agree that when we look at a chart, there are key levels that obviously dictate the turning points. The market is not chaotic. The market moves with some extremely or I should say, organized chaos. So the trick is starting to figure out how we determine these levels to dictate what the market's going to be doing. Once we've been able to how these rules play into the market, we can start reverse engineering what the smart money is doing and figuring out what that's going to tell us about what's about to happen next. Then we can start to look at the indicators and some of the things that I'm going to show you today to figure out where the smart money is going and where the highest probability move is. So let's start out by applying this to the S&P 500 currently. Okay. So let's go. Let's look at the S&P 500. So let's have a look at the argument on the S&P to start out. And I'm going to bring up a weekly chart. And so let's have a look at quickly what the similarities are of what's going on now compared to what happened in the last big crash of 2008. Firstly, if we observe the 2008 crash, you'll be able to see that throughout that entire 4-year period, essentially, when the market was rallying, we had a very, there we go, we had a perfect upward channel, beautiful upward channel. Now, what we look at when we start to observe something like this is we look at where this pattern ends to look at the indication of where a new pattern begins. And we can see that that occurred right there. That was when the S&P 500 broke out. So the moment, I should say a little bit further back actually. There we go. This is exactly where the S&P 500 broke above resistance. Okay, so then we're looking for the new pattern. Now, can everyone see, I'm just going to make this a little bit larger, but can everyone see what pattern then occurred on the S&P 500 back in 2008? Can everyone see the head and shoulders there? So this, just remember, this was the most chaotic drop, apparently. You know, if you remember, market madness, market mayhem. No one can predict where this thing's going. These are the kind of headlines you would have read in Yahoo Finance around the time of this crash. But is that true? I mean, let's have a look at what the technicals told us. We go and have a look at the head and shoulders pattern. We extend that beneath the breakdown of the neckline, and that's exactly where we went to. Okay, let's push forward again. What do we have then? We know that this pattern, following what I just spoke about, we know the head and shoulders ends there. So then we look at where the next pattern is going to be from that point onwards. And once again, another head and shoulders. We measure this particular head and shoulders. There we go. Look at the breakdown from the neckline. Okay, that's when that pattern ends. Okay, let's draw a support line there. This is where the consolidation of support happened. We then had an inverted head and shoulders down the bottom. If we look at the retracement of that, this is what brought us. There we go. This is what then rallied us back up afterwards. I'm just drawing this. There we go. This is where we reach the next resistance. Now, this is without looking at any fundamentals, without any news, without any noise, just purely looking at what the highest probability pattern in the market was telling us. Very, very accurate. Now, I'm not going to say that we called the absolute top of the market or the absolute bottom. We didn't. But these were the signals. These were the signals that we were looking at when we called an exit on the market on June 6, 2008. This was 7 months into our business. That's when we started, was November 2007. This is really what made us, was we talked about these factors, and we had our small client base of about 300 clients at that point, and we said, this is the end of the market. We're selling everything and going short. And that was probably where Acorn made its first stamp. The reason I want to show you this isn't to gloat, however. It's to simply make the comparison now to what is happening in today's markets. So how many people here, let's just have a quick look here. I'm just going to do a quick poll. So how many people here, by way of the poll, we'll bring this up here. Think the market is due for a crash? And how many people have thought that for quite a while? We're having our own little mini election here. Okay. Pretty much a 63-36 split. 65. I would vote yes as well, so we'll throw in that little bit of feedback. So about 2/3 of us here feel that we're due for a crash. All right. Well, there are some, rather than looking at opinions, because I feel that in stock trading, opinions really don't have much place. My opinion is the least important opinion of them all. What I think bears absolutely no importance of what the market's going to do. So I could think that company XYZ is terrible. I could think that that XYZ is a great company, but really what matters is where the market's going to be pushed. And to do that, we have to understand what these what the quantifiable factors are telling us, so we can measure what's going on rather than try and project opinions on the market and enforce our will. So let's go through these factors. Let's have a look at the S&P 500 over the last 5 years. Now, if you look here, you'll actually notice that over the last 5 years, the S&P 500 has been built resembled a very, very similar rally to the way it did over the 4-year time frame leading up to 2008. We are dealing with an upward channel. That upward channel was broken. Let's get some of these lines out of the way. This line was broken right here, and it was actually on July 26th that we once again came out and said this is going to be at least a 10% pullback in the S&P 500, possibly worse. We got that. We broke down out of the upward channel, and we can once more we can use measurements. So we measure in an upward channel, which is a bearish pattern. In other words, it breaks down, not up. We can look at that. We can measure the breakdown and have a look at that. This is the exact measurement of the upward channel. There you go. That is exactly how much we broke down. So market chaos? I don't think so. That is technical analysis at its best. Okay, so then we hit the support. What does that tell us to do? You can also see that was horizontal support as well from this smart money buy area. That tells us to take profits on the shorts. We then wait for the market then rallied back up. It retested resistance, and here was our second opportunity to short right there, which we did. And we hosted this very same webinar that we're having tonight back in July, and we also hosted it back in December as well. Okay, so moving forward, where does that position us now? So what we have building is a very interesting situation where we have broken down out of a bullish pattern in a bearish fashion, and we are now building something else. Now on the weekly chart, can everyone see that there is that potential here that we are in fact building yet another type of head and shoulders on a much larger scale? We've got a possible large head and shoulder here, and within that, a head and shoulder possible top building inside that. Okay, that's the early signs of what be building here. Now it could be bullish as well, and for that, so let's play the bear argument first. The bear argument technically is that we have a possible head and shoulders here. I'm watching this build now since March, and I'm waiting to see if it will form here. But this is the bear argument technically, is that we're building a large scale head and shoulders. The effect of that was we're looking for a drop down to about 1900, about 1980, another rally, and then a breakdown to complete the formation. So we're looking down at 1740 type of levels, rally back up, and then a much more serious breakdown from there. That's how that head and shoulders would potentially play out. Let's play the bullish argument as well, because right now we are literally in a very tight decision point zone. And in fact, the last couple of weeks we've had have been record levels of inactivity. It's actually the highest level of inactivity in the market since 1995. So let's do the bull argument. However, we want to give both sides a turn. What could we possibly have? I've turned the chart. Here we go. Okay. What we could also possibly have here is we could have an inverse head and shoulders, where this has been building here. And there could also be that argument as well. Either way, we are kind of at a very sensitive decision point for the market of whether we go higher or lower from this specific area. Okay, let's flip things back up the right way. All right. Now, I said earlier that my opinion is the least important one. That opinions really don't have a place in the market. It's not what we think, but what can we measure? What can we put into a rule system? Because I'll tell you, some of the best trades I've made in the last 12 months have been the most painful ones. They were the trades where I completely disagreed that the market should go up, but all of the technical indicators said it would, so I pushed the button anyway, intellectually feeling it was wrong, but made money on them. And they were some of the biggest profits I've had, but when I totally disagreed that it should happen. Does everyone understand what I mean by that? So if we're going to make decisions by the numbers, well, we're going to go into how we do that. But my opinion, for anyone who's interested, is that we are heading towards a big correction. That it is inevitable. That the question is not whether it will happen, but when will it happen? How many people would agree with that? That it's not a question of if, but when. There was in fact, there was something I was reading in the news actually the other day, where one of the hedge funds has had, I'm just trying to remember the name of it, but anyway, some of the best ranked stock traders in the world and best run hedge funds in the world had gotten together for a mastermind, a summit, where they all got together and basically have been looking at what the market situation is. Their conclusion was that basically the U.S. stocks are probably the best of the worst, and with low interest rates and stimulation that's going on, we're still enjoying the party. It's like the hair of the dog. You know, you might wake up with a terrible hangover, but hey, if you just keep on drinking, you'll be able to keep kicking that can down the road until it finally comes to roost, and you have to pay the price. You have to pay the piper. So I don't believe it's a question of if, but simply when. And so the things I'm about to show you here don't mean that I think necessarily the market is going to drop 30% in the next 4 weeks. But what I want to show you tonight is that for anyone who's seen that movie, The Big Short, how many people have seen that? Great movie. Why do these people have a movie made about them? These people have an entire movie that almost every trader has seen about them because they were brilliant. They took advantage and made billions of dollars over one of the biggest market crashes we've seen in our history by sniffing out the truth. And they scratched beneath the surface and they said, hang on a second, what's happening here has no correlation at all with reality. And we're going to start positioning ourselves and planning for that reality, because when it happens, we'll be positioned to make some really big boy money. And that's what I want to talk to you about tonight, is what those things are that are going on, how we measure those, and how we start preparing for that to protect ourselves, and of course make big boy money. All right, hang on a second. Looks like the monitors came off the screen. All right. Let's talk about where we are right now. Obviously, as we went into that breakdown of the channel, and as we rallied straight into resistance, this was when the hype was the highest. Market's going to break new highs. Goldman Sachs sees another 500 points on the S&P, blah, blah, blah. This was the perfect time to short. Whenever we were talking about how great the market's going to do, this is when this is usually the worst time to follow it, right? So we want to ignore that. We want to start looking at the quantifiable things. So what's quantifiable? Let's talk about some of the stories going on. We've got Asian economies in big trouble. Greece and other European nations in huge trouble. We had Brexit happen. We've had massive breakdowns in some big companies. We've seen weakness across the market. We are seeing what we are waiting for at the moment is the catalyst. Catalyst hasn't happened yet. But remember that once the catalyst does happen, I mean, so many traders tell me, well, you know, we'll start worrying about this big crash once it happens. Well, that's too late. They didn't make a movie about people that traded after the crash happened. We've got to start looking at the flags. So what kind of catalyst are we waiting for? Well, bankruptcies. We're waiting for countries and big companies to start going bankrupt, highly leveraged companies that start to crumble. That relates then to companies finding it difficult to borrow, consumer credit contracts, consumer confidence drops, spending contracts. And just remember, all of these things that start to happen when the crash occurs are always at their highest right before. Just before the D-Day, so to speak, credit's flowing freely. Everyone's flipping houses again. Everyone's borrowing money. IPOs are at record rates. Companies are starting to launch in the market. Market euphemism or enthusiasm is at its peak. Penny stock trading rampant. These are all key indicators of a market top. So it's always the best before it becomes the worst. But what we start to look for about when that top is coming is we start to look at where the smart money is going. Right now, Bank of America Merrill Lynch has indicated that in the month of March, it saw the largest level of straight selling, which is 5 weeks straight of selling, and redeeming equities that it's seen since 2008. The highest level of straight selling since 2008. Smart money is getting out. Now, does anyone remember what the market was doing in March? Was it dropping? Was the market tanking? No, it wasn't. In fact, the market was enjoying a very strong rally. But this month was where the highest level of selling since 2008 has occurred. Why? Because smart money likes to sell when things go up. People sell when things are going down. That's why people lose money and smart money doesn't. The reason smart money sells is because they've got a lot to sell. And if you're getting rid of billions or trillions of dollars worth of equity, you need buying. You need the people to hang in there as long as possible to get out of that bubble. What they're scared of is the $600 trillion of bubble that exists. Now that's a big figure. And if you want to read more about this, you can get a book called Juggling Dynamite by Danielle Parks. Great book. And she talks about the fact that there is this amount of bubble underneath the market. And when that pops, there's a vacuum that gets created. And that's why it's too late to take advantage of it then, because then you're chasing opportunities that are already down 20% and maybe get caught in a massive short covering rally. It's difficult if you come in after it's too late. So that's the bubble. Now that number, $600 trillion, is actually more than all of the real estate in all of the world added up together. That's how much gambling exists in credits, basically paper, betting on the market. Not value, but paper. This is why price to earnings ratios are now in question. Companies are not willing to pay a lot of money or buying companies which are charging high P to E ratios. Companies are cutting back on expenses. They're in survival mode. We're seeing all of these happening. This year, we've seen crazy amounts of volatility. We saw that massive drop and then a massive recovery rally. But most of that rally happened from companies buying back their own shares. It was also arguably we've seen an incredibly strong short squeeze, which has now run out of juice. One of the other factors, market rallied in March, February and March. As that rally occurred, again, smart money wasn't buying, smart money was shorting. And there was actually, as the market went up, there was $1 trillion shorting. I think it was by the end of March, there was $1 trillion at the end of March shorting the S&P 500. This is also the highest level of shorts on the S&P 500 since 2008. What we've also seen is gold and the US dollar go up at the same time. This also really hasn't happened since 2008. So are we in a bear or a bull market? Well, right now we have been since February in a bull market. But if we're going to try and be smart cookies, I mean, if you're going to do anything at all in life, why not strive to the best? We're not just going to mosey around and, yeah, maybe we make some money. I trade stocks because it's fun. Garbage. It might be fun, but do it and make money as well. And again, I'm not saying that the market is going to crash tomorrow. It could. It could be 3 weeks from now. It could be a month from now. It could be 2 months from now. It could be next year. I don't think it's going to take that long. I think we're getting into some very dangerous areas, and we are starting to see some significant cracks appearing. No one's going to be able to time it perfectly, but we absolutely, in my opinion, need to be prepared for it and start building our arsenal of how we're going to A, protect ourselves from it, and B, profit from it. And the fact that everything we've talked about, everything that's measurable, where is smart money buying or selling? They're selling. Is that we have record levels of shorts on the S&P 500 since 2008. Gold and US dollars are going up the first time since 2008. We're seeing the stock market break down and form a possible head and shoulders, just like 2008. I mean, if you see all of the same things that we saw back in 2008, and our response is, yeah, but this time it'll be different. That is the theory of insanity. Let's go one step further. Are the insiders doing? The people that own the companies that are the backbone of corporate America, the ones that see how much trade is going in and out of their warehouse, how much oil is shipping, how many people are buying, fluffy Pokemon dolls or whatever they're selling. What are they doing? Well, this is the insider report from March, at the beginning of that great rally that we've been having. This is the level, the red, by the way, is the selling. We've had record levels of it. April. This is like a Where's Wally puzzle. Find the blue in the sea of red. The only place there was any buying was in services, really. And that was an engulfing candle next to it, if you want to use stock market terms. So if this was a candlestick pattern, going long, wouldn't you? May. Right? Again, if these were candlestick patterns, you've got massive bullish engulfing candles there, telling you massive amounts of selling. That's April. That's May. That's June. Does everyone see the trend here? So I can sit here and tell you how strongly I believe it's this potentially big problem area we're coming up against. But I prefer to look at the opinions of the people that know best, the people that run Apple and Google and Amazon and all of these companies where this selling is coming from, Adobe. These are the areas that we need to look at. And so here's a summary of the last 90 days. So this is what concerns me. Again, I don't think it's a question of if, but simply when. And when we start to see that all of this is being confirmed by the technical analysis as well, that we're starting to see money flowing out, this makes that even more powerful. The last thing I want to show you here is a quick look at high yield bonds. This is one last, AMD, Facebook, absolutely. Corporate high yield bonds is one other thing I wanted to quickly show you here. And we're just going to go to a weekly chart. Okay. Corporate high yield bonds is basically where smart money goes if they for the risk on trade. If they believe that, hey, US equities are fantastic, this is the place we should be putting our money. Corporate high yield bonds are bought. They're betting big on corporate America. Now I'd like to show you a price comparison of corporate high yield bonds versus the S&P 500. one last little kind of tidbit. When you look at HYG, look at how much it really mimics the market. Market drops and plunges. High yield bonds go down with it. The green line is the S&P 500. The blue line is the S&P. The blue is the S&P 500. Sorry, blue and red is high yield bonds. The green line is S&P 500. It mimics each other perfectly until hin. Right there in January 2012, it stopped looking so much like each other. Through to 2013, it really starts to diverge. Can everyone tell me what happened in 2012 of any significance? What would have maybe happened in the stock market that where smart money would start to lose faith in the long-term picture? Quantitative easing. And we've been diverging ever since. We've created a bubble of our own. It's that big. Emerging markets have seen the drop. Europe is starting to correlate somewhat with reality, but we're creating a huge gap between real value and the hangover part 4, if I can call it that, using that previous analogy. We are in the hangover part 4, and if anyone's seen those movies, we know how much destruction goes on then. So these are the factors that are quantifiable and measurable that I'm looking at, is the patterns, the smart money. And one last thing that we'll look at really quickly here. I'd like to show you one last little thing. If you want to have a real quick look at where the smart money is going, just bring up FinViz. Simply and click on Insiders and just take a quick look at what the actual insiders are doing. Again, red means sell. How many confident CEOs do you see buying? Let's look at top insider trading. This is the largest sales of companies happening. What are the insiders doing? Right? Let's look at the top 10% owners. What are they doing? As you can see, it's a sea of red. But the market rallies. So once again, I'm not saying this is going to happen tomorrow, but it could. And the key to being able to take advantage of this is to start being prepared with opportunities. Not to get biblical on you, but Noah didn't start building the ark the day before the flood, did he? You know, just to use that as an example. This is the idea with trading. If we really want to maximize our profits, we want to be prepared for this. And the way we be prepared for this is by figuring out what the perfect short, the perfect storm looks like, and scanning for it. And that's really the big. And we'll start to talk about some of those opportunities here in a second. But this is where it comes down to being efficient. If we know what potentially is going to happen here, then let's start planning for it. Let's start building those watch lists. I've been building my watch list looking for the best and biggest shorts for 6 weeks now. And some of those have already had significant drops, but we're basically building our Christmas wish list, so to speak, of the perfect shorts. Scanning is very important doing that. Most people spend so much time working, but they're not working efficiently. In trading, you know, how many people spend all day looking at the screen? As day traders, you know this. It's the first couple of hours of the day where you get all of your profit, all of your action. It's not New York lunch hour. Some people spend all day looking at it anyway. there's certainly efficiencies to be built in. And in this type of market climate, what our process is to develop scans to find the absolute perfectly positioned longs and shorts for this market climate. The idea is that we're keeping all of the variables consistent in everything we trade, both long and short. So we're looking to replicate that perfect storm again and again and again, so we can trade it with the same variables, the same expectations, and so forth. And the scanning is where that comes in. Now we're going to go to questions here in a moment. Maybe we can have a quick look here. Just kind of trying to see how much time we have. Maybe Josh or Eric, if you just let me know how long we can go here with the questions. But this is where scanning really comes into play, and this is a very unique time in the market, where, as you said, as I mentioned before, we have been building a watch list for these last few weeks, and where this watch list comes from. Okay, thanks, Eric. Where this watch list comes from are these scans. I mentioned to you that this is what I've spent the last 10 years or more, really, designing, is finding ways to detect these perfect storms where all of those aspects I mentioned to you earlier are going on. Someone mentioned in the chat box that sounds complicated. It is if you have to figure it all out and do all the research yourself, but you don't need to. What we've developed algorithms and scanning methods that go out and look for the absolute perfect setup for where smart money is loading out right before a big drop. Let me give you an example of one of those. And this is what you would learn in this course. It's a live course. I'll give you the basics before we go back to the charts. It's a live course. It's the first time we've actually done this live since February of last year. It's been an on-demand course that we've offered, and because of where we're at in the market and because of how potentially imminent this drop could be, this is going to be done live in front of all of you next Wednesday at 5:30 p.m. Pacific. And in that first lesson, we're going to be covering the scan of how we created the scan for the perfect storm. We're going to be teaching you how we design our scans in general. What are the different aspects fundamentally and technically that go into the recipe? All of the things we consider. We're going to be telling you then what those specific criteria are that are built into this particular scan, searching for the perfect storm. So that you have a full understanding and a level of confidence in exactly why what this scan finds are absolutely wicked shorts. In the next lesson, and then what we're going to be doing with that, I should say, once we then taught you the scan and taught you why and how we built it and what its success is, we're then going to be going in and running that scan live and actually picking out the top shorts from the scan on that day. The next lesson will be the following week, the 24th, on Wednesday at 5:30 p.m. Pacific. And in that session, we're going to be going through and teaching you the opposite, the scan for longs. And this is where we're going to be showing you how we technically and fundamentally screen for the best opportunities to take advantage of when the market goes through its bullish mode. Because it would be silly to arm you only with a short scan, because as we all know, the market may go up for another 3-4 weeks, maybe another 2 months. So what we want to do is give you our best strategy for finding these, for how to scan for these excellent setups in both directions, so that we can be building an arsenal of trades to take advantage of longs in the meantime and be ready to push the button when we find the perfect short, either now or when that timing becomes right. So we want to really prepare you for both scenarios. The types of trades that we find with this, for example, one of them was Bristol-Myers Squibb. This is one of our favorites from one of our live lessons we did, one of our trading rooms we did a couple of weeks ago. So why Bristol-Myers Squibb? Well, have a look at it. Can anyone recognize the pattern here? Maybe I'll go back to the weekly chart. Can anyone recognize what pattern Bristol-Myers Squibb was building right there? What is that? It's the first half of a Head and Shoulders. This was one stock this was one of the very first stocks in our scan that came up. So our technical scan, built with fundamentals incorporated as well, found this and said, this is poised to plummet. We looked at the chart pattern. We confirmed that, yes, that chart pattern was in fact there. It was the first half of a Head and Shoulders, kind of like what we're building right. It kind of looks exactly like E500 right now, actually. Breaking above resistance, building that top. Looks almost like exactly like the S&P. And we said, okay, so we've got the Head and Shoulders, great. Let's look at the smart money. Let's look at the money flow. Money flow incorporates the stock's open, high, low, close, whether it's making new highs or lows, incorporates whether volume's going with the move or against it, incorporates whether the stock is closing high or low in its range as it progresses, looks at all the things that tell you whether money is coming in and sticking or whether it's a crap rally. Excuse my French. Whether it's just a false rally. If money flow is going against you, chances are smart money is not buying with you. They are selling to you. And the smart money had been declining on this the entire way through, right up to the point before it plummeted. Okay? And if we go and have a look, if we go and check out what the insiders were doing, now the way was days or weeks before announcing their approval or potential approval of their lung cancer treatment drug. A week away, Bristol-Myers Squibb was just about to announce groundbreaking drugs for lung cancer, but yet we're forming a perfect Head and Shoulders with smart money going the opposite way. So what were the insiders doing during this glorious time? Can everyone see that big red bar? We have a P/E ratio of 80, a high P/E. We have a look at, as they near in a groundbreaking drug, the chief executive officer, I should say, the senior vice president of enterprise services and chief information officer, the compliance and ethics officer, all of them, they're all selling millions and millions and millions of dollars, which is records level compared to any other activity they had in 12 months, just before an announcement like that. I mean, if you knew that you were about to cure cancer, would you be selling $10 million of your stock? Just a simple question. Now, who knows why they were? I'm saying I wouldn't be. No one in their right mind would sell before curing cancer. That just doesn't make sense. And maybe I'm trivializing it, but really, as a trader, I do want it to be as simple as possible. All I want to do each day is I want to click a button that's going to find me high probability patterns for shorts where the insiders are loading out, where money flow, as you can see on the bottom, is crashing. We have all of these perfect ingredients to find beautiful shorts. I want to be able to do the same for longs. So that is exactly what this course is all about, is teaching you exactly what that scan is, and how it's built, and what we do once we find the list. As a bonus, obviously this stuff is happening now. Next week could be too late. Some of the big moves that we're looking at on stocks, we are trading right now. We took positions in about 3 different stocks today. We're trading pretty much 50-50 in both directions right now. So what you'll gain access to instantly tonight is what we're looking at, what positions, what options. There's day trades. but the optionable trades are ones we're really looking at here for 1 month to 3 month, some even 5 month holds, where we're looking at very cheap options, where we're looking at the potential for a stock to plummet. I'll give you one of them. This is one of the ones you get on this report. Activision, ATVI. We probably only have about 5 minutes left here, folks. Activision Blizzard. Again, have a look at this stock. This is we go to the weekly chart. Activision is at the top of a Head and Shoulders. Activision is in gaming and leisure activity. Just so you know, technology development, application software, that sector has had the highest level of insider selling than any other sector other than specialty chemicals in the last 3 months. Insiders have been cashing in big time when it comes to software development. And ATVI is in that group. Look at the money flow. We are at the peak of a Head and Shoulders. Money flow is crashing. So just to give you an idea, February 2017 puts on that is what I'm looking to buy once it breaks its trend line. It hasn't broken it yet, so I'm still waiting for the confirmation to get in. But February $34 puts are $1.35. February $38 puts are about $2.90. They've probably gone down since I wrote these notes a few days ago, but that's what I'm looking to short. This is something that, regardless of a market crash or not, is setting up beautifully. All we need for it to do is to break this trend line of $40 and watch out below. These are the kind of things we're looking at already. So we don't need to have a crash to have stocks that crash. So again, you don't need to have the market crash to take advantage of this, but these are the stocks that you're going to get in the video report that you will get tonight. And that will summarize all of the positions that we're looking to trade, entries, exits, time frame, puts and calls, targets, rationale. And we've gone through all the research here, including looking at the insiders, looking at that track record, everything. You're also going to get the option for $9 to get our video reports on these stocks that we're trading and upcoming positions for a month. It's a smart money scanner series. Yeah, it'll be an option to add on when you register for the class. It's $9, and that's a month of our video alerts. So I don't want to change your strategy. I don't want to change what you're doing. It's working for you. But what we're going to be able to do here is give you another avenue to find some very palatable opportunities that are really setting up well, and put that through your rationale. One other thing, we do have as a bonus offer for those of you. I mean, we love CTU. Fausto's a great educator, and we look forward to working with you and helping you to explore the world of this type of scanning. As a special thank you to everyone over there at CTU, we are including, not only is this the first time we've ever done these classes live in over a year and a half, we're also going to be including a one-on-one session with your own personal coach so you can run the scans that you learn live with them and practice exactly what you've learnt to make sure that you're taking full value of the education we're teaching you here. That's normally $200. And we're also going to be including a video on open range, which is a strategy which we use on the S&P 500. I've run out of time to tell you about it tonight, but it's an hour-long video that will show you a method that predicts the S&P 500 to about 80% accuracy on an intraday basis, as well as a monthly basis, and we'll actually go through and show you the evidence of that. I'm not just making up figures. In that lesson, we actually go back and show you over the last 3 years exactly how successful that is and show you the proof. It is that successful. And that's a lesson on its own that you'll also be receiving. So we've only got about, unfortunately we ran out of time, but it's again, I highly encourage you to take advantage of it. It is a very fully inclusive course where we're going to be sharing with you our favorite longs and favorite shorts. I will share one with you here very quickly. just to give you an example of a long, this is an example of that. This is the kind of thing that we find on our long scan. This was coming up on our on the long scan that you would learn. I'm long 10,000 shares of this, just taking a little punt. So full disclosure. But this is the kind of thing that we find. RNVA, beautiful drop, beautiful consolidation, bang. One of my coaches was into this at 34 cents. I got in a bit later, about 38. I got a sell on this at 47 cents. Other types of things that you'll learn. Again, we're not going to have time to go through a lot of this, but VNet, another great example of exactly that. Now that was a day trade I showed you. This is a swing trade. But same kind of chart. Big drop, swoop, smart money buying, perfect chart. So as you can see, stock plummeting, money flow going the complete opposite direction. These are exactly where we look for our trades, and that's been 15% over 2 days. This is at 8% over 2 days, but this is actually also one we picked options on, which are up more than that. Target for RNVA is 47 cents. But yes, I'll bring up the link again. I'm sorry we didn't get as much time as I'd hoped to go through a lot of live stocks, but yeah, we'll be doing that. We'll be having about a 15-minute video coming out tonight with our top plays for tomorrow. RNVA was one for today, and we've got quite a few more that look exactly like that setting up for tomorrow. I'd be very surprised if you don't already make the $97 back just in the next couple of days from these alerts we're coming out. But that's I think that Eric, we've probably run our course of time. I thank you very much for giving me those extra few minutes. If you do have any questions, just shoot us a quick email at info@acornwealthcorp.com. We do have a live class tonight, being Tuesday. So anyone registering today, I'll make sure we get you included in on that live class tonight, so you can have a chance to ask all these questions and about some of the stocks that you may be interested in. Thank you so much, everybody, for a wonderful session and for all your feedback. I'll go over to the quick chat box there. Yeah, thank you so much, everyone. And trading isn't about certainties; it's about measurable probabilities. And hopefully, with these, you'll learn in these scanning sessions, you'll be able to really put a hell of a lot of probability in your favor by being in front of some of these excellent setups. Thank you, everyone at CTU, and look forward to seeing you all again. Hopefully, take care.